Welcome to Real MVPs, the channel featuring ordinary people doing extraordinary things. Let's check out this week's Real MVPs. Welcome to Credit 101. After working for 4 years at Bank of America as a senior collector in the credit card services department, I decided to create this clip in order to help you make intelligent decisions regarding credit card accounts and to help you save some money as well. Topics I'll be covering include credit scores and credit worthiness. We'll discuss what to do if you get in trouble and the differences between settlements, bankruptcies, and debt management. Credit worthiness is an assessment of the likelihood that a borrower will default on their debt obligations. It is based upon factors such as their history of repayment and their credit score. Lending institutions also consider the availability of assets and the extent of liabilities to determine the probability of default. A major asset that determines your credit worthiness is the amount of credit you have established. For example, if you have 4 credit cards and each one has a $25,000 credit line, then you have $100,000 in credit worthiness. If you close one of them, then you now have only $75,000 in credit worthiness. That's why you should never close up a credit card, because you are decreasing the amount of credit worthiness that you have. Your liabilities are the amount of debt you already have, such as mortgage, auto loans, and other credit card debt. The main metric used by institutions when determining if the individual is worthy of a favorable rate is your credit score. The credit score is a statistically derived number that represents a person's credit worthiness that is used by lenders to help determine the likelihood that a person will repay their debts. It is based on, among other things, a person's past credit history. It is a number between 300 and 850. The higher the number, the more credit worthy the person is deemed to be. Your FICO score is the most widely used credit scoring system. The FICO score uses various factors in 5 areas to determine credit risk. Number 1, your payment history. Number 2, the amount of debt you currently have. Number 3, types of credit used. Number 4, the length of credit history. And number 5, new credit. 35% of your score is based on your payment history. It is important to try and never be late. 30% of your score is based on the amount of revolving debt you owe in relation to your available balances. Make sure you don't borrow more than 50% of your available balance from any single lender. Ideally, you want to borrow less than 33% of your available balance. It is better to owe a smaller amount on several cards than to max one card to its limit. 15% of your score is based on the length of your credit history. People with credit scores over 800 typically have several cards open with low balances that have been open over 7 years. 10% of your score is based on the type of credit, installment versus revolving debt. Revolving debt is money owed to a creditor who sets your monthly payments based on current balances. Credit cards or retail store cards are examples. An installment debt is a set loan amount paid over time with a fixed payment schedule. An auto loan and mortgage are examples, and is looked upon more favorably than revolving debt. Inquiries and new debt account for 10% of your score. If you're shopping for a house All inquiries within 30 days of each other will be grouped as one inquiry. For autos, it's a 14-day limit. Inquiries for new debt, however, have less of an impact than they used to. FICO scores range between 300 and 850. A FICO score above 650 indicates you have a very good credit history. If your score is below 650, you will have a difficult time obtaining financing at a favorable rate. During the height of the collapse of the housing market and subsequent bank bailouts, I got a call that broke the proverbial camel's back. It was from an 85-year-old woman who couldn't understand why her minimum payment wasn't bringing her balance down that much. It wasn't in my job description, but I always tried educating cardholders that it was best to try paying at least 3 times the minimum payment. Otherwise, they would end up paying 2 to 3 times the principal owed on their account over time. The minimum payment is designed to pay the finance charge with only 2% going towards the principal, and therefore it could take you decades to pay the account in full. In her case, I knew she would be dead and still owe a significant amount on her credit card. I had such a hard time explaining this to her, and I really felt sorry for her. I saw my congresswoman questioning the bankers on CNBC one day, and I sent her an example of her situation. At the time, the banks weren't disclosing that information on their statements, and from a consumer's perspective, I felt they were legally robbing people, and it was very egregious for them not disclosing these facts. I can't say for sure that my letter was the catalyst, but not too long after that, all of my credit card statements reflected those points. Never, ever pay the minimum payment. Try and pay at least 3 times the minimum payment. Only pay the minimum payment as a last resort to keep your account current. As you can see from an example of her statement, she had a $10,000 balance. The minimum payment was $595. Of that $595, $250 went towards her finance charge because she was in penalty pricing on her interest rate. And that could have been due to her being late and a significant amount of time. And if you're a day late and just $1 short, you're going to get that $25 late fee. It doesn't make a difference why you're late, you're going to get that late fee. So she was getting that late fee. Then that generated the penalty pricing on the interest rate. Okay. So now it was $250 a month for that. Okay. So that probably sent her over her limit. That and the credit protection plan that she probably didn't need. She was paying $85 for that credit protection plan. Now, I personally think that it might have been a lot more than that, but I recently checked with the bank just to find out what they were charging for those credit protection plan, and they said it was 85 cents per $100. So I gave them the benefit of the doubt on that one and say that they probably didn't reduce it from what it was when I thought I looked at it, and it said $250 a month, okay, which really got me upset. Now, in addition, she, like I said, she had $35 over limit fee every single month and $25 late fee every single month. So of that $595, only $200 was going towards the principal. Do you see why she was never going to pay that off? Never. Most of that money was going for the finance charge, the credit protection plan, the over limit fee, and the late fee. So that's the situation. Those are the reasons why you never, ever want to be late if you can help it. I would really seriously think about that credit protection plan. I personally would never get a credit protection plan. What I would do is save some money. If I thought I was going to be sick, or if I was going to be lose my job, I would use that money that I saved every month, extra money saving for that purpose, to pay the minimum payment. What you want to do with that money, instead of giving it to the banks, is you want to put it in your 401 or get you a Roth IRA or something like that. Then, if you got an emergency, okay, well, look, just go ahead and take some money out. And if you take it out a little early, so you might get a little bit taxed, but at least you're going to save your credit, okay? Think about that, please. Don't let the banks rob you. The banks get a portion of that credit protection plan every single month. Some of it goes to the insurance company, but the banks get their cut as well. So you don't want to give the banks any money if you can help it. Think about that. Save some money instead. As some of you may know, the banks participated in what I consider a master con game called mortgage-backed securities. And what they were doing, they were taking these mortgages that weren't really worth the paper that was written on, and they were packaging them as securities, and they were selling them to other banks and individuals around the world as investments, okay? So what happens essentially is you got these houses, say for example, that were only worth $50,000 selling for $250,000, and everybody was using that as a piggy bank. Hey, but guess what? What goes up must come down. Eventually, those houses are just not going to keep going up and up and up. So that's what happened. There was this big crash in that whole industry they called mortgage-backed securities, okay? So the banks at one time, I was watching CNBC one day, and the Goldman Sachs employees, all of them were averaging $25 million in bonus money, okay? Selling those mortgage-backed securities. And here we are right now, people are bankrupt, they're losing their houses, so on, jobs, so on and so forth, okay? Now, what I do with my debt, I play what I call the balance transfer game. I don't pay high interest rate. In fact, I don't pay interest rates at all. What I do is pay balance transfer fees, okay? There is more to follow, so hit us back.